Hey, morning, ladies and gents. Just now, this video here, what I'm going to do is I'm going to cover fundamentals and how they make the market move. Okay, it's probably going to be about a 30 to 40 minute video, but I'm going to cover each thing that I've covered on this PDF that I made up for you. All right, we're going to go through it step by step. We can also see it's basically telling you how to read this, right? Forex Factory, sorry, and how to piece it all together. Okay, pardon me. So I'm just going to go through it here. Fundamentals are the major driving force behind what makes the markets move. Okay, they're responsible for every major move you see, whether that's long or short, up or down. In this document, I'm going to explain each piece of news to you so that you can better understand what you're looking at and, more importantly, looking for when you're waiting for news numbers to drop. Okay? Excuse me. I've put a little word key here. So bullish, long, hawkish, buys all means you think the market's going up. Okay? Bearish, short, dovish, sells all means you think the market's going down. All right. DXM, whenever you see me posting something that says DXM in a Discord channel, excuse me, it means dumb money index. Don't ask me why it's not DMX. I don't understand that either. But DXM means dumb money index, okay? And what that means is retail traders, basically you and I, okay? They call us the dummies because most people who trade like retail, sitting in their living room, playing on their iPad, their laptop, their mobile phone, they're just gambling, right? They don't actually want to learn the skill and the art of trading. They don't want to put that work in. So whatever retailers are doing, we want to be doing the exact opposite. All right. And that's it. Pretty much retailers, when you look at this platform here, right, this tells me if retailers are all in buys, we want to be in sales. You want to be doing the exact opposite of what they're doing. Okay. Now, this one here, COT, it stands for Commitment of Traders. Okay, it's basically the banks, hedge funds, JP Morgan, Morgan Chase, excuse me, all these kind of things. Now, basically, it's the people in the know. All right. Now, Commitment of Traders, what happens there is that every single Wednesday, by law, all the major corporations and institutions have to submit the trades that they are actively in. Okay. Excuse me. And that's required by law. It's to try and stop things like insider trading from happening. Okay. So they get submitted on a Wednesday. They then get checked and verified to see are they true or not. And then every Friday, that information gets submitted. And for those of us who use platforms like this, let's just say we go on AUD-CAD, we then have access to that data and that information, and that can massively help us trade. Okay, here it is here, COT, Commitment of Traders. So we can see here on this pair, AUD-CAD, they're all in sells just now, right? Now, that's happened because of the war. I'll cover that later. It actually, economically, it should be buys right now because AUD is strong and CAD is weak, okay? But what happens is, that's during a risk-on period, okay? But when you get an immediate war, you instantly come into what's called a risk-off period. And pairs like AUD become exceptionally weak, okay? And they start melting, absolutely melting when it's risk off. Now, during a risk off period, pairs like AUD become very weak, USD becomes strong, CHF, Swiss franc, is a safe haven, so that becomes strong, oil becomes strong, and gold becomes strong, okay? Now, one of two things happen to turn it back onto a risk-on period. Excuse me. The war will stop. It will be a very short war, like we can see with Israel and Iran. I think they've kind of agreed, look, this isn't a war. I just wanted to slap you, and you just wanted to slap me back. Okay, so it's not going to continue, hopefully. So it's a rapid risk off scenario, which you can see the market's just absolutely collapsed on some pairs and absolutely rocketed on others. Okay, that's the reason why. Now, if the war has stopped this week, you'll see by Wednesday or Thursday, the market then becomes risk on again, and pairs like AUD CAD will flip around and it will go back into being a long and not a short, okay? The only reason why this has become a short right now is because of the war. Another way that the markets can change from risk off to risk on is that if the war actually just keeps continuing, then after about a week to 10 days, the markets will switch back to being risk on, even though the war continues, okay, because life moves on, right? As you've seen with the likes of Israel and Palestine, it's just continuing, and you saw previously with the likes of Russia and Ukraine, okay? The war keeps going on. When the war first kicked off, oil went flying, gold went flying, you know, it was phenomenal, and then you saw about 2 weeks later, markets all went back to normal and gave us retracements, okay? Even though the war still carried on, and that's what happens. The markets will be risk on pretty much 98% of the time, okay? We all want risk on. That's where everybody makes money. Risk off only happens in a time of war or something happens across the globe, which brings uncertainty for a short period of time, okay? As you can see here, look, all the retailers, they're all in buys right now, right? And if we scroll down here, 76.9%, let's just round up to 80%. 80% of all traders lose money with this provider. So that's telling you that 80% roughly of retail traders lose their money. Why would you copy these people? Why would you now enter buys and follow them if 80% of them are wrong? Okay. And then we look at COT. And banks are predominantly in sales. Why would you enter a buy, right? If the banks, the people who have the amount of money required to actually make the markets move, right? They trade tens of millions per trade. We trade, you know, fucking 50 quid. We ain't going to move the markets, guys. These are the boys that move the markets. So we want to be copying these guys, and we want to be doing the exact opposite of these guys to make money. All right? Now we jump back on. Excuse me, a pip. The word pip means price interest point, okay? A pip is a unit of measure denoting a monetary value. For example, 1 pip is the equivalent to 100 million US dollars. So if the market moves 17 pips when you're in a trade, it means that $1.7 billion has been exchanged within that period of the market moving during that period of time, okay? During that candle or whatever it is. A lot. 1 lot is called a standard lot. It's the equivalent to 100,000 currency units. It's the standard unit size for traders. An example, if Euro USD exchange rate is 1.3000, 1 standard lot of the base currency, i.e. Euro, would be 130,000 units. Now, if you're confused by that and it fries your brain, you don't need to know it, right? It's like being in the army and they tell you every single little thing about a radio and you're like, mate, I don't need to know this. Just tell me how to turn the fucking thing on and tell me what my frequency is, you know? The rest of it, I don't give a shit. It's pretty much like that, okay? You don't need to know it. This isn't going to determine whether you have winning trades or fuck off, all right, lads? It's just a terminology. A standard lot is 1, you know, so you can be 2 standard lots, 2.0, 3.0, they're all standard lots, okay? A mini lot is 0.1, 0.2, 0.3, 0.4, and so on. A micro lot is 0.01, 0.02, 0.03, and so on, okay? Base currency. The term base currency in trading, we trade one currency against another. For example, GBP, GPY. The base currency is the currency at the front, i.e. GBP, okay? If we trade NZD, USD, it means that NZD is the base currency, and so on. Now we're coming down, we're going to cover the central bank, all right? Now, the central bank has a million jobs to do, essentially, okay? But the primary job that you and I care about as traders is the central bank's primary job is their aim is to keep inflation below 2%, okay? So their aim is to bring inflation from 0% gradually up to 2%, excuse me, gradually up to 2%, and then when it gets to 2%, they're supposed to bring it back down to 0%, back up to 2%, and so on and so forth, okay? They do this at 2% because it doesn't take long to get back down to zero. Okay, now this is important as when markets are coming back down, this is known as deflation. During periods of deflation, this is when our lives feel hard. Nobody has any money. Banks won't give you bank loans. You can't get a mortgage. You can't get an overdraft. And things are generally pretty grim for around 2 to 3 years. Okay? Markets are there to make money. The markets are there to be bullish, all right? They're not meant to be bearish. They're always 98% of the time, markets are there to be bullish, all right? i.e. going up. And therefore, the whole world loves when markets are bullish. Markets become bullish for a duration of usually 5 to 8 years. During this period, everything is great for everybody. For the everyday person. Banks are handing out loans willy-nilly. Credit cards are being, I should say offered out to you. Sorry, it's a typo. I'll fix that. Are being offered out to you. Everyone's buying new cars. Mortgages are easy to get. And generally, everyone's spending money and enjoying life. Right now, top currencies like GBP, USD, Euro, etc. are all over 5.50% inflation. Okay, that's more than double what they should be, which means when the crash comes, deflation, it's going to hurt and probably last for about 3 to 5 years. Okay, so you're going to have like 3 to 5 years of everybody being in the fucking hurt locker. Okay, lads. Now, I'm not going to take you through each of the important economic factors and what they... I'm now going to take you through each of the economic factors and what they mean one by one. My apologies. So, the inflation category, pardon me, CPI, Consumer Price Index. CPI measures inflation and the price of goods in a basket of shopping from the grocery store. Basically, each month, quarter, and year, they'll buy a basket of foods from the grocery store, like Tesco or Asda, and they will note the price of it. Okay, they'll continue to do this each month, quarter, and year, noting if the price of goods is going up or going down. This gives us a good indication if the economy is growing, shrinking, i.e. inflating or deflating. CPI also includes goods and services. If CPI is high, it means bullish for the currency, and vice versa. If it's low, it means bearish for the currency. Okay, but that's just one piece of the puzzle. You can't just say CPI low. You have to look at everything that I'm going to cover here, okay? And you have to piece it all together. Sometimes all of them can be, 90% of them can be good. That's bullish. 90% of them can be bad. That's obviously bearish. And it can be 50-50 where this is good, that's bad, that's good, that's bad, that's good, that's bad. And that means sticky. So it would be neutral, okay? Core CPI. When doing core CPI, they remove energy and food because these things can also go up in price during different seasons like winter or summer, and therefore they do not give you a true reflection of the economy, all right? Prelim CPI. It comes early in the month and it can give us an early indication of what the main numbers may look like once they're realised. Final CPI comes at the end of the month. Personal consumption expenditures, i.e. PCE, is the American version of CPI. This differs from core CPI that only measures goods and services targeted towards and consumed by individuals. Prices are weighted according to total expenditure per item, which gives important insights into consumer spending behaviour. CPI is released about 10 days earlier and tends to garner most of the attention. All right. PPI, Producer Price Index, is a leading indicator of what CPI numbers may be later. What else does that measure about PPI? It also measures inflation from the perspective of producers by measuring costs of the products that they use. It gives a good idea about the CPI, okay, and how that's going to turn out. Excuse me. Average earnings. If wages go up, it means people make more money and spend more money. Okay, this is great for the economy. So if the average earnings are up, it means that the currency is stronger, i.e. bullish on that particular currency. So you would, if you're marking your notes down in your jotter, you're looking at the news report on Forex Factory, you would mark that down as a positive if it's up, and obviously a negative, a weak if it's down. JOLTS, Job Opening and Labour Turnover Survey. Okay, this shows the number of job openings each month, excluding farm work. If these numbers are high, this is positive for the currency, bullish. If they're low, it's negative for the currency, bearish. Employment numbers high equals bullish. Employment numbers low equals bearish. Unemployment numbers high, bad for the economy, bearish. Unemployment numbers low, good for the economy, bullish. Non-farm payroll, the famous NFP. Okay, this is released on the last Friday of every month and is a huge market mover for USD and gold. It shows the change in the number of employed people during the previous month, excluding the farming industry, okay, non-farm payroll. They do this because farming work is seasonal, and therefore including it would give false readings of people being in work and being out of work, when it's not that people are being unemployed in the farming industry, it's just that it's seasonal. So of course, after the harvesting season, those employees get cut, and that's just part of it. Gross domestic product, GDP. This is the broadest measure of economic activity and the primary gauge of the health of the economy. Okay, is it good health or bad health? An increase in GDP means bullish. A decrease in GDP, therefore, is bearish. Points to note: GDP is higher in months like December because it's Christmas and therefore everyone's spending in December. Okay, December's numbers are shown in the January GDP release. So bear this in mind and remember it's because of the Christmas spending, and that is to be expected. As it's expected, it means a lot of the time it's always priced in. So it may not really affect on the market when it's released in January, okay? i.e., what that means is if you're sitting there waiting for these numbers to be released in January and you think, right, if that's positive, it's going to be buys because the currency is going to fly, it's more than likely they've already priced in, they've already bought in. The market's already pushed up because of it, because they know in advance it's already going to be high numbers, and therefore the market doesn't really move when the numbers come. Sometimes that can happen. You'll be watching here, you'll be sitting here watching the news, and you'll be like, why isn't that flying? The numbers are all great. It's because it's already been priced in, okay? A recession is when GDP comes in lower twice in a row. Okay, a recession is when GDP comes in lower twice in a row. That's known as a technical recession. Balance of trades is the difference between import and export. Are they making money or are they losing money? Is there a deficit? House Price Index, HPI. This is the change in the selling of homes as it increases. As it increases and houses become more expensive, it shows growth in the economy, bullish for the currency. Equally, low numbers equals bearish for the currency, right? Consumer sentiment. If this number increases, it means bullish, and if it decreases, then bearish. This is not very important. It's just a nice little. It's just a nice little extra nicety, okay, for consumer sentiment. Retail sales, another important one. This tracks the spending of consumers. This is very important and it brings a lot of volatility to the market. If people are spending, it means the economy is in good shape, equals bullish. If it's decreasing, it means things are not so good and will be bearish for the currency because people aren't spending, okay? Purchase Manager Index, PMI. For PMI, various countries, different PMIs, have different PMIs that make the difference. For example, I've kind of fucked that up there, but I'll change that. All countries have manufacturing PMI and services PMI. All right. Now, depending on the country, depends on which one we care about the most. Both of them are important for each, but there's certain countries which one is more important than the other. For example, for China, Japan, and Germany, we care about manufacturing PMI the most because these are countries which manufacturing many things, including cars, etc., and it's a big part of their economy. All right, manufacturing PMI has a big effect on these currencies, whereas services PMI not so much. For USD, GBP, and Euro, we mostly care about services PMI because these countries / regions are countries which provide services like banking, etc., and not so much manufacturing. And therefore, services PMI has a bigger effect on these countries than manufacturing would. Of course, that's a little bit kind of twisted there because you've said Euro, and then we've obviously got Germany up here. Okay, so you have to kind of take that with a pinch of salt. And there's more countries in Europe, obviously, which are services based. And we only have the one country, Germany, which is manufacturing based. Okay, so you have to bear that in mind. I know that may sound a little bit oxymoronic, but yeah, that's welcome to the world of trading. When PMI numbers are above 50, it equals expansion. It's good for the economy, equals bullish. When PMI numbers are below 49, it equals contraction. It's bad for the currency, equals bearish. Okay, now you might look on PMI numbers one time, and it's went from 43.5 and it's went up to 47.2, and you think, oh, that's great, and it shows as green as well, right, which I'll cover in a moment. It shows as green as well, and you think, oh, that's positive. No, you have to look at the big picture. Yes, it's showing that it's improving because it's increased and it's in the green. However, don't be fooled by the colouring being green. If it's below 50, it's bearish. Okay, it has to be above 50 to signify the currency being bullish. Okay. Speeches give clues about how they think the markets economies are doing, but they do also try and trick you in speeches. That's why I don't bother so much. Risk on. Risk on is about 98% of the markets. Okay, the market is 98% of the time risk on. It means bankers, etc., are happy with the economy, so they're willing to take more risks, i.e., give loans very easily, credit cards to everyone, give mortgages, and so on. Okay, we like trading risk on as markets are bullish. Risk off is when bankers are more afraid of the current climate and are afraid to give loans out, etc. This usually happens when a war breaks out, as we've just seen, or something bad happens, i.e., COVID, right? When a war starts, risk off starts. However, if a war continues, markets will switch back to risk on, even though the wars are still ongoing. An example of this would be Russia and Ukraine. Markets went wild when that kicked off and gold flew, but after a week, the war carried on, but markets went back to normal, i.e. bearish, or however they were. When we're risk on, these commodity currencies will go up. So that's AUD, NZD, CAD, crypto, and stocks. When we are risk off, these assets will go up. CHF, GPY, USD, metals, and bonds. Okay, safe havens are USD, gold, bonds, and also CHF is actually a safe haven as well. Okay. Yeah, and have I covered that? Oh, that's pretty much it. Yeah. So another point to note. When it's risk off, I haven't put it in here. I can update it. When it's risk off as well, things like AUD will absolutely melt. Okay, so risk off, these commodities will go up. AUD will melt when it's risk off, as you've seen. We've physically seen that, right? We'll jump across here. Look, boom, you see that big melt? It's exactly what it done. Now, if it switches back into risk off, this will become a buy again. The reason why, pardon me, this has been pushed down, Canadian dollar is weak as piss. However, because of the war, what happens to oil? Oil flies, right? Oil and gold flies. This was when the war kicked off here, right? This is when the war kicked off. So we'll be looking to, again, to see where this goes. I really want to see it come down here, reject, and then go, but we have to play it by ear, right? We've got this area and this area for potential reversals. But you can see this right here is where the war kicked off and markets went wild, all right? That there provided strength to the Canadian dollar because Canadian dollar is very heavily correlated or tied in with oil. So when oil is going well, that means Canadian dollar gets strength, even though the Canadian dollar is not actually strong, right? It's as weak as piss, but you can see it forced it down and now things are starting to level up. So that's how it works, okay? And when you come here, let's just see, is it ticked? Okay. What you really want to be doing is when we check all these, You can see all this news here. Okay. Now, you really need to be putting everything together, piecing it all together. When you look like this in full, that just shows you all, and it's quite hard to kind of distinguish. Okay, I'm just about to make another video doing the reviews on this. Okay, so I don't want to confuse it up. But what I normally do is, in fact, you know what? Fuck it. I'll do it in this video, so it's all one combined video. What I do is when I'm checking the news, right? This is what I do. For each pair, I normally do each and every single pair individually. However, for these three pairs, Aussie dollar, Chinese yuan renminbi, and New Zealand dollar, I do all them together. It's because they're very heavily correlated together, okay? If the Chinese currency is doing well, it means AUD gains strength and AUD will do quite well. If the China currency is doing badly, it means AUD will do badly. It's because they're very heavily correlated. They do a lot of work together, basically, okay? And kind of the same with NZD. Let's have a look. So all I do, lads, is I come here, I go to last week, and then I look at the numbers of the important stuff. So China industrial production, obviously we want to really focus on that because China is a production country, right? It's massively down, so that's not quite strong. China GDP quarter on year is good. It's went up. Retail sales, not so good year on year. They've came down massively. Fixed asset investment, okay, that's better. Unemployment rate is sticky, hasn't really moved. A little bit better, but it's not nothing really. CPI quarter on quarter, it's pretty sticky, it's pretty shit. That's the NZD is weak as piss. Employment and unemployment change. So we can see it's quite a big drop. Employment has changed quite significantly. Unemployment, okay, unemployment's a little, is that better? Let's have a look. Less. So I don't know why that's showing in green. Oh, I know why it's showing in green. It's because they forecasted that. This is a good point here. Don't get caught out with this. They forecasted it to be 3.9 and it's less than the forecast. But look, it's more than what it was previously. You see that? So don't let this being green fool you into thinking it's good, okay? You have to take it into context. Actually, it's worse than before. The reason why it's showing green is because they forecast it to be 3.9 and it's came out better than they forecasted it, but it's worse, all right, than what it previously was. Let's look. Pardon me. This is China loan rate, it's fine, that's sticky. Credit card spending is down. So again, NZD is weak. Flash manufacturing, we want to see this in services PMI. We're going to check that tomorrow. Previously, it was above 54.4. So remember I said if this is high, it's going to be bullish, right? This one is low. Like I said, it doesn't have that much of an impact. We do take it into consideration. However, it's not a manufacturing country per se. It's usually China, Japan, blah, blah, blah. So this one being down, okay, it is. We do need to note it. But this being up as a services country that provides services and commodities, etc., then that's a good thing. So that being high above 50 is positive and makes the currency strong, okay? A big one this week for EUD, we want to see CPI quarter on quarter, CPI year on year, and the trimmed CPI. We really want to see these. That's pretty much it for the Aussie dollar, okay, this week. So it's strong. Aussie dollar is still strong just now. You can see this previous weakness. That was because of the risk off which happened, okay? That will change again this week. Let's see how the war pans out, but it should be changing again. And then what I do is I then cover each currency independently. So I always come up here, change it back to last week, have a look at last week's numbers. As you can see, guys, the Canadian dollar is weak as piss, okay? It's dog shit. Everything's negative about the Canadian dollar, so you would put that in the category as weak in your notes, right? No real major news. We're going to see core retail sales month on month and retail sales month on month here. So we really want to see that on Wednesday, but it's going to be shit, right? Because the economy's bad. everybody's broke. Their fuel prices are through the roof. Their energy bills are through the roof. Their pricing for food is through the roof, right? So people aren't spending that much money. Everyone's broke. So these numbers, you can already, get a good idea. These numbers are going to be shit, okay? What's giving the Canadian dollar that false sense of strength, and don't get fooled by this, is that it's very closely correlated to oil, as I mentioned. So if oil is doing well, it gives a little bit of false strength to Canadian dollar, but do not get that mixed up with meaning that Canadian dollar is strong, okay? It is not strong. CHF is always it's always a shit pair. It's always a safe haven. There's never any news for that, to be honest. No news. Nobody cares. It's a safe haven. I've got it down as weak. Yeah, pretty poor. It's always like that. Euro. Don't forget to hit last week. Let's have a look. Poor. For Euro, when it says like Spain and Italy, we don't care. We really just care about Germany and France, okay? Just so you're not, look, Italy. I mean, who gives a shit? Nobody cares. Look, German economic sentiment, 42.9. It's up. See, previous was 31.7. The forecast is 35. And it's massively higher, okay? Do not get fooled by that. It's still negative. It's showing that it's increasing and the economy's potentially getting better, yes. However, it's weak. Why? Because it's below 50, okay? Anything, even if it's 49, that fucking thing is weak, all right, lads? Above 50 is strong. Final core CPI year-on-year euro, sticky. So that's just weak. There's no progress. German PPI, a little bit better, a little bit of strength, but yeah, it's only month on month, right? So it doesn't really have much weight. For me, euro is weak. Let's see what it's going to bring us this week. Okay, guys. Tomorrow we've got French PMI, manufacturing and services. That's good. And German. Yep. So all this Tuesday is a big day for the euro. It'll confirm if it's going to remain weak or if it's going to come into being neutral. If it's mixed data, like this is, look, they're all below, right? You've got this one which is above 50, this one which is above previously. So if that's below, up, below, up, and they're all shit, then that's going to be weak, okay? But if this is up, below, up, below, up, like that, it's more 50-50, then it's going to become neutral. You understand how that works? You really need to put everything into context, all right? And that's pretty much it. Tomorrow's the big news for the euro. We'll decide if it's going to remain weak, which I've got it as down as weak, and we'll see. But I believe it will be because the Eurozone is pretty shit right now, guys. Let's have a look. GBP. Oh, sorry. The pound. The pound for me is in a kind of strong / neutral area, okay? Claimant count changes as people are claiming unemployment benefits, that is up, so that's bad. Don't be fooled by it being green. It's bad. It's only green because they expected it to be 17.2 and it's now 10, which is lower. So that's green, but it's far higher than previous. Okay, that's just very fucking bad for the economy. That means there's more people claiming the dough. Okay. Average earnings is sticky, hasn't changed. Unemployment rate has increased. So there's more people unemployed, which is not good for the pound. CPI is less. Okay, it's green because it's more than forecast, but it's less than before, so that's bad. This is less, so that's bad. PPI, all of it's less, so that's bad. Okay. RPI, bad. HPI, it's better than before. It's better than before, but it's still shit. Okay, it's still minus. Retail sales, shit. So the pound hasn't come into weak yet, but it's definitely now neutral. It's no longer strong or strong neutral. It's definitely down at neutral right now. Let's see what news we've got for this week coming. We've got flash manufacturing PMI and flash services PMI, which is going to be very important. If these both come in above 50, it'll give a little bit of strength, but we'll have to see is it coming in less, okay, showing that it's going down. If they still come in above 50, but it's less than previous, then it's showing shrinkage, right? The economy's getting smaller. Things aren't looking good, which adds to it being neutral, okay? So it's a pretty flat pair at the moment. And this is really how you read it. Japanese yen, let's have a look. Japanese yen flash manufacturing PMI. Want to see that, but look, it's below the 50, so shit. Tokyo core CPI. Want to see this, and we really want to see how these come out. Okay, that's pretty much it. Let's have a look at last week. Manufacturing orders were good, but it was only month on month, so you get an initial little spurt of growth. But if the year on year is less, then you're not going to see that growth. Okay. I'm still weak on the yen for now. NZD we've done, sorry. USD, pardon me. Core retail sales month on month are up. Empire State Manufacturing Index is still low. Retail sales is lower than previous. It only says green because it was forecasted lower, but it's still not that good. All these numbers are pretty much low, negative. Unemployment claims are sticky. Okay, so that's not neither bad nor good. Fed manufacturing index is up, so that's good. It's way up, so that's good. Existing home sales is a little bit less. Natural gas storage 50 billion. Okay, so we don't really care about anything else there. And we really want to see this. So look, if it remains above 50, remember, that's bullish. This is what's giving the USD its strength. We're still strong on the USD for now, okay? Especially now there's been a war, because USD is a safe haven as well when there's war, because it goes up, and so there's oil and gold. Crude oil, advanced GDP, want to see that. Unemployment claims, you want to wait for this. Advanced GDP price, we want to see that. Pending home sales, core CPI. Yep. So there's quite a lot of news that we want to see this week from USD, but I'm bullish on the USD. Okay. So to summarize, guys, my strong pairs which are strong, is AUD and USD. Of course, AUD is coming down just now purely because of the risk off sentiment. But when that comes back on to being risk on, which should be this week, then overall we are strong Aussie dollar. Okay. Buys. Against weaker currencies like the Canadian dollar. And USD is strong, okay? Weak is Euro, Swiss franc, New Zealand, Japanese yen, and Canadian dollar, okay? They're all weak. So we need to bear that in mind. Neutral is GBP. The pound sterling is neutral, okay? And that is it for now, lads. I hope that's been useful. Sorry for a couple of those typos on the form. I will get that. I will get that done up. But that's pretty much it. Okay, this is how you read the news. I know it's a little bit hard to get used to. If you watch this video, you're thinking, "Fucking hell, my head's fried." Don't worry, it's perfectly normal. You need to be spending some time on this on a Sunday and doing what I just done there, going through each individual pair, going to last week, and then going to this week, and just practicing by yourself. Okay, if you ever forget what something does, just go like that. It tells you right here why traders care. Frequency, usual effect, actual less than forecast is good for the currency. It literally tells you all of it here. Okay, so don't worry if you, oh God, what does final services PMI mean again? I forgot. Just click on it and it'll tell you. And you can see all the previous ones, forecast and the results. Okay, so you can see if it's going up or going down. All right. If you come across here to the graph, you can actually see a graph which shows you a better visualization of it. Okay. So yeah, don't worry if you don't get it right away. It's perfectly normal. Trading takes time. If you were going to be a doctor, just because you've graduated from medical school after 5 years or 7 years, whatever it is, you don't instantly just dive in and become a consultant, because you still need to gain the experience, right? You've learned everything, but now you need to back that up with experience. It's exactly the same in trading, guys. Trading is one of the hardest industries in the world. You're trying to take money from people who are far more educated with you in the market. They have access to far more information than you, and they have huge amounts of capital, whereas we don't. Where we have the advantages, we can get all of their data on items like this and places like this, and we can actually enter the market far easier than these guys can, because they're trading tens of millions, if not hundreds of millions each time, right? If they enter too much, the price is going to fly. They're going to get fucking mountains of slippage. So they don't want slippage. So that's why they have to scale into the market very slowly. And that's why you get pullbacks. They make the market pull back, they'll enter a lump, make the market pull back, enter a lump. And that's why you get all these pullbacks in the market, because they're trying to scale into it at a better price without the rest of the world seeing what they're doing. Okay, we don't have that problem. We can enter the market right away, which is definitely an advantage we have over the bankers and the big institutions. Okay. So I hope this video is important to you. I'm going to post it in the general chat now, and also the fundamentals section, so that you can always come back and look at it. But just keep practicing, lads. Okay, I can't tell you how important that is. Let's have a great week.